The Fed left rates unchanged, which was expected, but the bigger takeaway is that they're still in wait and see mode with inflation not quite where they want it. Alongside that, comments from Jerome Powell around his tenure added a layer of uncertainty, and the market didn't respond well to it. On the housing side, home values rose for the seventh straight month, showing that demand is still holding up despite everything else going on in the world. Good afternoon. I hope you had a great April as we kick off the month of May. Last week brought a packed economic calendar with fresh inflation data, a Fed meeting, and updates across the housing market. At the same time, uncertainty around the Iran conflict continues to hang over the markets. While the ceasefire technically remains in place, progress toward a longer-term resolution has been limited, and the activity through the Strait of Hormuz is still restricted. That uncertainty showed up quickly on Monday, with stocks selling off and bond markets under pressure as investors weigh the risk of further escalation and rising oil prices. We've seen that spill directly into mortgage rates. The 10-year Treasury on February 27th, right before this conflict, closed around 3.96% and then opened this week closer to 4.44%, which is a significant move in a short period of time. In my opinion, we're going to need to see some real progress towards stability, especially around energy markets, before rates can move back toward where they were earlier this year. That being said, let's look at what happened last week. Here are your headlines. As expected, the Federal Reserve left its benchmark Fed funds rate unchanged at 3.5 to 3.75%, marking its third straight meeting without a change after cuts late last year. While this rate doesn't directly determine mortgage rates, it plays a major role in shaping borrowing costs across the economy. So what's the bottom line? Although the pause was widely anticipated, the decision revealed growing division within the central bank, with 4 officials dissenting, the highest number in decades. One favored an immediate rate cut, while others pushed back on signaling that cuts are likely ahead, even as they agreed to hold rates steady for now. The split reflects the Fed's ongoing balancing act. Inflation is still above target, while some signs point to a cooling job market. Adding global uncertainties, and it's clear policymakers are proceeding carefully. In his remarks, Jerome Powell also shared that he plans to remain on the Federal Reserve Board as governor after his term as chair ends in May. That comment didn't sit well with parts of the market, particularly those who have been more critical of his leadership, and it added some pressure during the press conference. Now, headline personal consumption expenditures, or PCE, rose 0.7% in March, driven largely by a surge in gas prices tied to the Middle East tensions, lifting the annual rate to 3.5%. The Fed's preferred inflation measure, core PCE, which excludes food and energy, increased a more moderate 0.3%, with the annual rate at 3.2%. So what's the takeaway? Inflation is still running above target, reinforcing the Fed's cautious approach. It also helps explain why some policymakers are in no rush to cut rates, as they weigh mixed signals across the economy and await certainty regarding geopolitical issues. Now, in housing news, U.S. home values edged up from January to February, rising 0.3% before seasonal adjustments and 0.1% after, according to Case-Shiller Home Price Index. Year-over-year, home prices are up 0.7%. Now, data from the Federal Housing Finance Agency, or FHFA, shows prices were mostly flat month over month, seasonally adjusted, with a stronger 1.7% annual gain for homes backed by conforming loans. So what's the bigger picture? Home prices have now increased for 7 consecutive months per Case-Shiller at roughly a 3% annual pace. This shows the value of home ownership even amid a volatile and quote-unquote higher interest rate market. That demand is still out there supporting home prices. Now, in other housing news, housing starts rose nearly 11% from February to March as builders ramped up activity despite ongoing affordability challenges. Gains were seen in both single-family and multifamily construction, likely supported by better weather. At the same time, building permits fell by a similar margin, an early sign that future construction activity may be starting to slow. So what does this mean for you? While the jump in housing starts came in well above forecasts, drop in permits suggests that builders are becoming more cautious amid what is going on in the world and for the potential of cost to build to climb with the spike in oil prices. This week will be another busy one for the markets with a full slate of labor data on deck. We'll also be getting more housing updates, starting with new home sales this morning. From there, the focus shifts to the labor market with job openings released this morning as well, followed by private payroll data on Wednesday, weekly unemployment frames on Thursday, and then Friday's highly anticipated jobs report which includes non-farm payrolls and the unemployment rate. It will be interesting to see what the labor market data will look like after receiving a higher than expected inflation reading last week. Remember, the Fed is closely monitoring the rate of inflation and the strength of employment, and it decides what the next steps of their monetary policy will be. I'll fill you in on what takes place on Tuesday, but for now, have a great rest of your week.